What's up, YouTube? It's Joe Catchpolia sitting on the couch, making some money, investing in fractional real estate online, as usual. Today I'm going to look at the new property that was just launched on Lofty. It's in Peoria, Arizona. It's a three-bedroom, I believe, two bath and a loft. I think it's actually a condo. Although it's one that doesn't necessarily look like one. I think it is. They may be townhome style condos. I'm not positive. I actually should have really looked at that. There's a whole bunch of stuff I want to cover about it, and so um, yeah, that's kind of funny. I didn't really look at the physical characteristics of it that much, but I think it is. I think it is attached to the neighboring properties. It is a condo though, because I looked at the association bill. Looks like a very nice property. Yeah, that's the wall, and that's the neighbor's apartment. Yeah, or unit. The co-owner that brought this to the site is already pretty active in the Discord. He seems to be a pretty straight shooter, giving us some real yes or no answers to questions. If he doesn't, so far my interact or actually haven't interacted with him, but I've read everybody's, and I think that they're good. I think it's a good sign. He seems to have some experience in investing. He's has some other properties. He invests in other stuff as well. He's a veteran. I think that always makes me like someone more, just because I am and lots of my friends are. Um, Started investing not too many years after I did, so he's at least gone through some a period of time with his properties. Although it says he started investing back then, but did he start buying properties back then? Because he also mentioned his stock investing and some other thing. That's something you can read a little bit more about him. As far as for what he's trying to do with this property, it's not super complicated. So I think it's just nice to have someone that seems like they're just going to be straightforward with you. But I don't think that it's there's not some complicated plan with this one that we have to figure out. Like, is he going to be able to execute it? I'm going to start off, Peoria, Arizona. Not a market I'm terribly familiar with. The first thing I always like to do, let's look at the growth rate, and it's a city that's been growing very fast. Um, I love to see that. That's just a good sign. When you have extremely fast growing populations, it's good. It's typically good for housing, right? Now I think it's an area where there's also a lot of room to build, so that's the negative side. But so it's not a huge market, right? It's 190,000 people, but it's part of the Phoenix metropolitan statistical area. You can see it's up here, and this is the Phoenix MSA. That way I don't have to say the whole word. I don't know. I'm really tripping over words today. I've talked a lot, so it's the end of a long day. But that market, that's a pretty good size MSA, and it's also very, very rapidly growing. So I was very pleased to see that. As always, checked out the national risk index for the market. It's pretty high risk, right? Relatively high risk. I'm always using this expected annual loss tab. One of the things, and I think we've talked about this before, but though more densely populated areas are always darker because um, there's more stuff to damage, right? But so what I really like to do is look at these, how often different occurrences happen and what the actual risks are. I mean, you have some earthquake, hail, heat, hurricane. If this is the stuff that you're really worried about with your asset, you want to really, this is something you can dig into quite a bit more. I didn't spend a lot of time on this. I'm going to get into the things that I think are the bigger issues with the property. But so this wasn't one of them, although, depending on the places that you're investing in, this might have a higher disaster risk than a lot of them. So then I jumped into looking at the actual housing market. They had a really strong run up to 2022, and actually a bigger drop than a lot of markets that we look at. But it looks like it's sort of leveled off, although I don't love the little bit of a downward trend. Um, but I would expect, as I expect with a lot of the fast growing markets, that this has to do with the pacing of new construction, and um, obviously interest rates had a lot to do with it too, but I think that the markets that you see that just have kept moving up are ones that have limited supply as well. I think this area, it's probably, it's likely that there's opportunity for a lot of new properties, and so like I mentioned, in some markets, the newer properties that are being put out in a lot of markets are actually just cheaper homes. They're smaller, and so it brings down the median without necessarily bringing down the average price per square foot. That's something I'm actually not sure if that's what's going on here, but it is a trend that we've seen in a lot of the markets where there is still quite a bit of new construction, which I'm sure there is here with how fast they're growing. Um, you can see in the last year there's a little dip in prices in that median, but not terrible. I think, obviously this wouldn't have been a great time to own, but this would have. One of the things that I think that this co-owner is, just really upfront about is he thinks, yeah, this property is not really making money, and I'll show you what I mean by that in a little bit. But he thinks that it's going to be a strong, he's really holding it for appreciation. I mean, that's what he thinks the play is here. With how fast the market's growing, I don't disagree with him. I think that that is a good sign. If that were my main goal in buying this property, um, I'd spend a lot more time digging into, new construction that's for sale, new construction that's underway right now. Um, it's very rarely my goal is to buy something that doesn't make money, but that is, set to appreciate. But so that's my personal take on it. There are definitely people that have done very well, investing for appreciation. I mean, any real estate investor in most of California, like that's, you're not, I know a lot of people out there that made a lot of money investing in properties that had negative cash flows. Which this one actually does, and I'll get into the numbers in a little bit, but I want to just go through all the actual physical characteristics and market. This is one of the best looking crime maps that I've ever seen. It's actually, I know I said that last time too, but this is really good. I mean, when I pulled up the spot crime, nothing shows up in this area, and I don't know. I mean, obviously, this is not too far away and not great, but I mean, there were, and it went back kind of far, relative to some of the other ones, at least, um, a couple of weeks back, and there still was just nothing, right where the property is. One big negative for me, it's in a flood zone. It's in this 1% annual risk of flood. Let's see, what is it? 1% annual, that keeps disappearing or moving. 1% annual chance flood discharge. But it's just, I don't understand what this is contained in structure, what this is, but just the color on here, I believe is just matched up to this, because when you move it fast, this is what the map is supposed to look like. So this appears to be in this section here to me. Um, I think it's this and not this. I'm not really positive, and I spent a while dragging around on this map to see, because it's clearly loading this layer, and like whether this layer, I think it's this, and this is that 1% annual, with an average less 1% chance annually with an average depth of less than 1 foot. So it's not a huge flood risk, but it is. I just don't like dealing with properties in flood zones. I don't like having to pay flood insurance. I don't like having to deal with, if it does flood. It is just a hassle, and because we have so many opportunities, it's just been something that I've always avoided. Um, I looked around. I couldn't actually get into the community with the Google Street View, so it drives me nuts whenever that's the case. But it is a gated community, and I think it's a good sign that it shows like the gate was working that day, because sometimes the car will drive in there if it can. Um, but the driving around here, this is something I always like to do, right? And I didn't see anything that worried me at all. But again, something that you might want to spend some time on if you think this is a deal you're going to put some money in. One of this is one of my first complaints here. So the appraisal says it's worth 390. You can see in the financials, 4095. And so what are we doing there? I think he's doing the full 5%, right? So 390 0.05. Yeah, so he's doing the full 5% premium that Lofty will allow you to bring a property up to that much higher than your appraised value. Um, I don't love that, right? Like for me, okay, if I think I'm buying into this, and my main goal is appreciation, but I'm starting 5% in the hole, at least below what the appraiser says. I don't love that. Now, Zillow actually thought it's worth a little bit more with 406. And then they have it was actually last sold, I think, for 404. So when did that sale happen? Um, I think, yeah, sold, listing removed, listed for rent. Yeah, sold, just last year, right? Sold for 404. So he hasn't owned it very long. Um, I get why if you just bought it last year and you paid, so he's not charging a lot more than what he paid for it. But we did look at that market and prices have declined. So, again, I'd much rather to buy the properties that are a discount to their appraised value, not ones that are, that I'm paying more than their appraised value. So that for me is an issue. You can see, okay, it looks like it has fantastic rental yield. I want to dig into that a little bit more because at the moment, I think it is paying out a very strong yield. It's really simple. It's a long-term rental, so there's not a whole lot to think about. I looked at, he is using a property manager. Uh, their property management agreement, um, they charge $79 per month, which is being picked up in the financials, that which ends up being this 948. But they also charge so they charge a $200 lease renewal fee. So there's going to be an additional 250. Did I say 250? Yeah, or $200. There's going to be an additional $200 um, taken out somewhere every single year, even if it's a renewal. And then if it's a new lease, you have $300 for each new executed lease. Plus, they're going to charge you a $300 advertising fee, or $295. Um, Plus, they do these move out inspection. Costs another 150. Then these other annual tech fee. So it ends up we're not actually picking up all of those expenses in this annualized yield right here, but it is most of them. This utilities number actually looks like what it is let's see. This is the condominium association fee. It's $182 starting in January. When you multiply that by 12, that's where this 2184 comes from. So yeah, I'm glad they're accounting for that. One of the things whenever I buy condos, if I'm going to make a significant investment in it, I actually want to see the condo's financials, like the condo association's financials, because if they're running at a deficit, if they have a lot of debt, if they don't have a reserve, that could be an indication, um, that you'd have a bigger expense coming up, or a higher monthly fee coming up. Now, I don't know that I've actually asked for that on any of the condos on this platform. I only have a little investment in one condo on here. It's something that if I'm buying a condo in real life, I do every single time. But if I'm buying like a little piece of one, I mean, you have to measure your risk and reward also with the amount of time that I'm spending on each deal. It is something that I think is important and does add risk to your deal, but you have to decide, like, is that really worth it to dig into those financials as well. Um, so if they got their property taxes, I actually didn't verify these two, the property taxes and insurance, but at the moment, let's just take everything at face value. It means that it shows a monthly cash flow of $1,644. That's after the management fee, after the HOA fee. That's assuming you're collecting rent, right? They don't ever stick a vacancy rate or repair and maintenance rate or anything when they do these projections. They're assuming everything's perfect and full. Well, okay, so $1,644. What is he actually paying on his mortgage right now? Let me just start closing some of these. Well, his monthly mortgage payment at the moment is $2,529. Now, if you recall, if you've looked at other deals on Lofty, as the co-owner, he's responsible for making the mortgage payments. Um, and the cash flow is just divided up between the equity holders. Well, and I've talked about this lots of times. I think that's perfectly fine. If in order to help juice your yield. But from a risk perspective, I always want to know, like, is this cash flow, could this property carry this cash flow if for some reason the homeowner can't do it anymore? That some reason the co-owner that brought it to the site can't do it? I mean, the answer is very clearly no, right? I mean, we're $900 below what the current payment is. I did notice his discussion in the Discord, was about, like, I was trying to sell about $75,000 worth, and somewhere around there is when he thinks he'd be able to refinance it. So let's look at the debt and what's actually going on here, right? So currently the property has a mortgage of $317,000. When we look at the order book, that's represented by these. Um, that's the difference between these equity tokens and this, 8,228 total tokens, right? So, like, okay, let me just do the math on that, right? 8,228 times 50, that gets you to that 411 total investment. And I think I didn't actually point that out, but let me show you there. That's the 409,500 plus the other closing costs and fees, right? But then on top of that, we want to look at, so that's the total. And so then when you take the total, and then you subtract what the people have referred to these as, like, the floating tokens. I don't really know why, but that's how most people have been talking about them. What's left over are the tokens that are associated with the debt. Multiply that by 50. Yeah, this is right around the amount of that debt, right? It's actually a little bit higher. Sometimes they're off. They're slow to adjust these sometimes, for sure, the mortgage getting paid down. But so currently the 1,859 times 50, represents 92,000 in total equity that he can sell. And he said he's planning to sell about 75,000, so not keeping a whole bunch of equity for himself, meaning that he'll have to pay pay that mortgage out of pocket completely. So that's one of the things we have to understand: is he capable of doing that or not? We're very rarely given that any information to indicate that. But then basically what he's saying is, once he's got about that much, he thinks he can refinance the mortgage. I was actually not so sure why it had to be, why he would need more cash to refinance, but I'm assuming he's saying he's going to pay that down. If you're going to make an investment on here, I would suggest jumping into Discord and just asking about it, right? Like, is that really what's going on? Is he going to pay the mortgage down when he does a refinance? And if he does, if he pays it down $75,000, that means that he's going to almost double. Then that releases those tokens that are associated with the mortgage, and so that's going to almost double the total tokens in circulation that represent equity. And so what that will do is actually cut this rental yield in half, right? And it's not exactly, because it's 1,500 tokens, not 18 or whatever. So it'll be, it won't quite cut it in half, but it will be very close. And so if you're buying into this because for the yield, it's just good to know that at a certain point, it seems like that's the goal, is to be able to pay down the mortgage, some refinance, and then when that happens, your yield is going to get nerfed a little bit because of that. You can tell I've been playing video games with my kid too much, right? Like, he's always talking about things getting nerfed. Well, like, your yield's going to go down because of that. And then at the same time, you have to just remember, like, this yield is a perfect month's yield, right? It doesn't reflect any vacancy. It doesn't reflect any repairs and maintenance. It doesn't reflect any, the fees that happen on turnover or at least renewal. Like, all of that is going to impact this. And so, if you think about it, even though it's a high yield, when we look at the financials, it's really, that yield is just this $1,644 a month. it's not a ton of money to account for any of those things, right? Like, well, one, I mean, if you have a month of vacancy, but you still have a lot of other expenses as far as, you're going to be negative, and that's why we have ORs and whatnot. That's why, you'd want to have some money set aside for the property to do that. So that's, and he did mention actually in the Discord, this co-owner mentioned that he had some money that if he had to cover the mortgage, I don't remember how long he said, but for a little while that he could do that. So I don't know. It is like, to me, this type of deal is, and I know we have a lot of them on Lofty, but it's just like, if you bought this property in real life for this price with this mortgage, you'd be losing about $900 a month. Um, he's taking that loss and making the payment, and in return, and which is what makes it so you can get a yield. This yield, I think, is very fragile because, like I said, any vacancy, any repair and maintenance, like, you have a $500 expense one month, and this drops down to 14%, right? I mean, so roughly. That's just my, in my head, guerrilla math I'm doing. It's about a third. It's about a third. Um, but so, you have that issue. You have the issue that it doesn't cover its own debt. Um, you have the potential of this, basically your yield getting almost cut in half if he does do a refinance. He'll benefit from that, right? Because he'll have a lower payment if the interest rate goes down and he pays down a certain amount. But at the same time, um, your yield will go down considerably. It will reduce your risk a little bit, right? Because then maybe the property could actually cover itself if you wanted, if it had to. Um, so at the end of the day, you've got the flood zone issue, which, I've noticed a lot of you are okay with that. Um, and in some markets, it's just like you just kind of have to be if you're going to be in that market. But for me, where we just have the choice of every market imaginable, uh, I'm just being more picky than that, right? It's because I just know that, you know it can just cause, even a little flood, like, it can just cause like months of rehabbing your home, and moving your tenant out, and just, so even though it's a low risk, I just avoid those. And so you've got that, you've got the fact that even if you had no other expenses, just the rent is lower than the mortgage payment, right? Is that true? Yeah, rent 21.49 a month, and the mortgage payment is 2,529. Like, I just have a really hard time buying a deal like that, even though I do like this market, right? I think that it's tremendous growth. I think it's a relatively landlord friendly market from what I know. That's something else you might want to dig into more. But it is, I think that you're paying a premium for it, right? You're paying more than the appraised value. And, yes, it starts off with this really juicy return or yield, but I don't believe this is going to last, right? One, I think it goes down anytime you have vacancy or repairs or maintenance. So I think your average yield over the year, even if there's nothing else happening, is going to be significantly less than this number. I mean, it's going to be something less than that number. But then on top of that, once if that mortgage does get refinanced and it happens with cash in, then your yield is going to go down considerably because there will be more tokens in existence, right? More of the equity tokens. Um, for me, I just don't really see the risk reward there relative to a lot of other deals that we look at. Um, I mean, it does just, I really have a hard time with buying a deal that, if it in an emergency, couldn't pay for itself, right? If whatever happens, that the co-owner can't make that mortgage payment. And that is my biggest concern with this one. The flood zone, is the next one. Um, the chance of your yield just getting cut in half is the next one, or not quite in half, but, and then what happens to your token price if that happens, right? Because this on Lofty, people are always chasing yield. So if your yield shrinks, that means your token price is probably going to go down as well. Um, Not that that's a rational response, but that is the current market response. Um, Let me see. I think that's really all I wanted to say about this one. I did forget to mention, please like and subscribe. If you're not already, you can join the Discord that's in the there's a link to it in the description to this video. And in addition to that, there are links to all the sites where I'm currently investing in short-term, or not short-term rentals, but in fractional real estate, so Mogul, Lofty, uh, Collab, and all of them you want to do your own due diligence. Don't just invest in them because I did. Same thing with the properties, right? This is just my opinion of this property. Just because I decided not to invest in it now doesn't mean that you shouldn't. Is this one that I'm going to buy into when the price goes down? And I don't want to say like the price is just going to go down, but every property pretty much has dips at some point or another. Um, I don't know. It's still even in that situation, you still have the situation, the issue with the debt, and that the rent doesn't cover the debt. Now, in the future, if he does successfully raise the capital, pay down the mortgage, refinance, um, sure, maybe the yield will be lower. Well, definitely the yield will be lower in that scenario. But I think a lot of the risk would be taken out if that refinanced payment ends up being um, below what our cash flow is. Oh, that's one thing actually. Let me look back at that loan document. Is this, it's not quite as bad. Um, but it is still right, because there, the taxes and insurance are double counted in what I was doing, right? So, your payment includes your taxes and insurance escrow. So really it's like 2,300 and the income is 1,600. So it's not a $900 deficit, but it's still a pretty significant deficit. Um, yeah, for me, it's a tough deal to get excited about. It really is, and I mean, he completely it was upfront about it. That it's an appreciation play, and if that's what you're looking for, and you're comfortable with the risk of potentially owning a property that is upside down when you buy it, meaning not upside down, not they don't have more debt. A lot of times people say that to mean they have more debt than it's worth. But I mean that it's you have paid more than it's currently worth when you bought it, and you have the risk that if the that you that the it can't cover the mortgage payments. If you're okay with those and you're okay with the flood zone, I can get on board with thinking that it's going to appreciate quickly, just because it's such a fast growing market. But again, if that were really if I'm buying strictly for appreciation, I would want to dig into much more of what's the new construction market look like there? What are the new homes selling for? Are there just tons of them? Because that's what's happening in a lot of markets is builders are just, banging out just tons of homes. And so, even though the demand for homes is continuing to grow rapidly, it's the supply keeps up. You don't keep getting the appreciation like you might expect. That's really all I have to say about this one. Uh, I am curious if you're going to buy some of this one. Let me know in the comments or jump in the Discord and let me know. That's it. Until next time, I'm going to just keep making mistakes so that you don't have to.